Good morning, everyone, and a very warm welcome to our spring tax update. Thank you all for joining us today. It's great to see that we have so many attendees, so thank you. I'm Craig Walker, Tax Director at Hawsons, and together with tax partners Stephen Charles and Aaron Hemmington, we'll be talking you through some of the latest tax changes and looking at how the changes may affect you, your business, and also your clients. Next slide, please, Rob. I should just say we expect the presentation to last about 45 minutes in total. If you do have any questions, if you could please enter those into the Q&A box, and then we'll try and answer as many as we can at the end of the presentation. So yeah, just pop those into the Q&A box as we go along. So many of you will already be familiar with Hawsons, but for those of you who aren't, we're a long-established firm. We're set up in 1854, and we consider ourselves a leading independent firm of accountants and business advisors. We have 3 offices in Sheffield, Doncaster and Northampton, and around 100 staff in total. We cover all areas, including tax, wealth management and corporate finance. Next slide, please, Rob. So today we're covering all the main taxes. I will be starting us off talking about business tax, and then Stephen will take over talking about national insurance, employment tax and VAT. And then last but not least, Aaron will be updating us on recent changes to personal tax. Next slide. So starting off with business tax, and looking firstly at companies, it seems like we've had a corporation tax rate of 19% for a while now. I think it was back in 2017 when it changed to 19%. So we're all very familiar with corporation tax being at 19%. Unfortunately, that has now changed. So from April this year, if your company has profits over 250,000, you'll be paying tax at a higher rate of 25%. So quite a jump from previous years. If your profits are below 50,000, you will continue to pay tax at the rate of 19%, at the small companies rate. And if you're somewhere in between, so if you have profits between 50,000 and 250,000, then the company will pay tax at the main rate of 25%, less marginal relief. So you will end up with a hybrid tax rate. So quite a significant change from previous years, and it was one that we expected to come in, although over the last year or two there was a bit of sort of, will it come in, won't it? But yes, it's finally come in. Next slide, please, Rob. So in previous years, it's tended to be more tax efficient to pay a dividend rather than a bonus. Obviously, with the rates now going up, the rate of corporation tax going up to 25%, that does alter the calculations and potentially alters the thinking there. So now it's not always a case that it's better to receive a dividend rather than a bonus. So for this next year, for the 23-24 year, it will be a case of having to crunch the numbers really to see whether you're best at receiving salary or dividends. It's not as clear cut as it was in the past, but it can certainly be beneficial to receive it may be beneficial to receive a salary rather than a dividend if you're in that 50,000 to 250,000 bracket, where you're paying an effective tax rate of 26.5%. So that's something to watch out for this next year, and obviously have a chat with us about that. Next slide, please, Rob. So capital allowances is next on the agenda, and there are 3 changes that I want to highlight this morning, 3 quite significant changes. The first one relates to the annual investment allowance. So we've had the annual investment allowance for a number of years now, and the the threshold, the maximum allowance has changed over the years. Some years it's been, I think, as low as 10,000. Tended to be sort of around the £200,000 mark. I think it was back in 2019 when a decision was made to increase it to £1 million. That was initially on a temporary basis. So we were expecting that would drop down to £200,000 from this month onwards. So it came as quite a nice surprise that in the spring budget, we were told that the £1 million threshold would be permanent. So that provides some certainty going forward as to what the annual investment allowance will be. And obviously for many people, £1 million is more than plenty to cover their spend on plant and machinery. So for many businesses, they will receive 100% tax relief on their plant and machinery in the year of purchase, in year one. Worth flagging that the annual investment allowance is available to companies as well as sole traders and partnerships. So some of the things I'm going to talk about are just for companies, but this is available to all. And also I should just flag that some expenditure is excluded from the AIA. Things like cars are excluded. Before I go on to the next slide, I just want to cast your mind back to 2021 and the introduction of the super deduction. So back in 2021, we were told that this new super deduction would be introduced, and the idea was to encourage companies to invest in plant and machinery to increase productivity and get the economy going. So that came in very generous. If you want to flip to the next slide, please, Rob. The very generous regime. It offered 130% tax deduction in year one. So extremely generous, more generous than the annual investment allowance. Only applied to companies, not sole traders, not partnerships, and it was extremely popular. One of the reasons why it was so popular, I think, was because it was uncapped. So even if you had an extremely large company spending, say, £300 million on new trucks during the year, they could claim the super deduction on the entire cost. So it's extremely generous, very popular amongst the large companies. That has now been withdrawn. So with effect from the 31st of March this year, super deduction has now gone, and that was confirmed in the spring budget. So yeah, so obviously many sort of very large companies were concerned about this, because they benefited massively from this. Next slide, please, Rob. So that went, super deduction went, but a new regime was introduced in the spring budget, something called full expensing. So again, this is available to companies only. It's not available to partnerships or sole traders, and it provides 100% first year allowance for main rate expenditure, and then a 50% allowance for some other expenditure like integral features. So again, this is uncapped. So this is very popular for large companies, where £1 million doesn't really mean much to them. So yeah, I think this will be a very popular introduction. Some will say that it's basically the super deduction that's been rebadged, because it effectively gives you the same rate of tax relief as you did before. So if we cast our mind back to last year when we had the super deduction, the tax rate back then was 19%, and the super deduction offered an extra 130% deduction. So that gave you a rate of tax relief of about 25%. Obviously now tax rates for companies is largely 25%, and this offers 100% relief in year one. So again, we're looking at an effective tax rate of about 25%. So you could say it's all changed, but really has that much changed? We're still getting tax relief at a similar rate. And whilst we're on the topic of capital allowances, just wanted to remind people that if you're looking to install an electric vehicle charging point at your business, then you are able to claim 100% relief on that in year one. It was confirmed in the spring budget that will continue until 31st of March 2025. So we've got some certainty there. Next slide, please, Rob. It was also announced in the spring budget that there will be 12 new investment zones across the UK. So Liz Truss had talked about this previously, and what we ended up with was a watered down version, really, of Liz Truss's plans for investment zones. So we're told that there will be 8 investment zones across England, so some close to home. So we may be able to benefit from this. This is a 5-year package, and it offers some additional tax reliefs. So things like stamp duty land tax relief, enhanced capital allowances, and NIC savings potentially as well. So if you are looking to invest in these areas, then you could save a fair bit of tax. Next slide, please, Rob. So moving on to R&D tax relief, we've seen quite a few changes in this area. So I just want to run through some of the main ones. So first of all, I guess it's important to flag that this relief has been around for about 23 years now. I think it was 2020 when it was introduced. Sorry, it was year 2000 when it was introduced. Obviously, the world has changed quite a bit over the last 23 years. Things like AI are now very popular and coming in. So I think it was time for a bit of a refresh, really, in terms of the types of expenditure that qualify for relief. So we've been told that some additional costs will now be eligible for the relief, things like data costs, cloud computing costs, and pure maths costs. So that will be of benefit to some companies who are undertaking R&D. They've also said that they want to focus the R&D relief on investment in the UK. So going forward, if you're subcontracting R&D, it will have to be done in the UK. There is a very narrow exemption for overseas expenditure, but yeah, I think in reality it'll be very difficult to qualify for that. That's coming in from next April, so we've got a bit more time to get our heads around that particular change. The other changes regarding R&D tax relief. So at the moment we have 2 R&D schemes. We have the SME scheme for small and medium enterprises, and we have the RDEC scheme for larger companies. So typically the SME scheme has been the more generous scheme of the 2. So that's been the one you want to claim under if you meet the conditions. We were told that the SME scheme is to become less generous. So if you are an SME claiming R&D tax relief, unfortunately, your claim will probably diminish this next year. So we're told that the additional deduction you can claim in your tax comp will reduce from 130% down to 86%. Of course, it's still worth making the claim, still very generous, but not quite as generous as it was in the past. We've also been told that if you are a loss-making SME, then the repayable credit you can claim that will reduce from 14.5% down to 10%. So again, that's sort of bad news for SMEs. There is an exemption to that rule if you're spending more than 40% of your expenditure on R&D. So in some circumstances, it may be possible to continue to get the credit at 14.5%. So the SME scheme is becoming less generous. The RDEC scheme is becoming more generous. So if you're claiming under that scheme, then I've got some good news for you there. So the RDEC rate will increase from 13% to 20%. And I think what we'll see next April is that these 2 schemes will merge into one, and going forward we will just have one R&D scheme, and that scheme is likely to be very similar to the current RDEC scheme. So yeah, we've not seen all the details about that, but that's the expectation, that from April we will just have the one scheme. So So plenty that's changing in R&D over this next 12 months. Lots for us to get our heads around there. Next slide, please, Rob. And the other thing to flag about R&D is that obviously HMRC perceive that there's a lot of abuse and fraud in this area, particularly from SMEs. So we are seeing increased scrutiny from HMRC. They've allocated additional resources to investigate R&D claims. We understand there's at least 100 additional officers at HMRC, and they're focused on looking at R&D claims and making sure that the right amount is being claimed. So be aware of that. Obviously, make sure your claim is as robust as possible, and also some additional changes are coming in. So going forward, you'll have to make your claim digitally. You'll have to include additional information in your claim. So you'll have to include a full breakdown of the costs incurred and a description of the R&D that you've undertaken. So there'll be a special form to complete with that information. So that's expected to come in August. The claim will also need to be endorsed by a senior officer of the company, a named senior officer. So again, I think that's HMRC just wanting the director to be aware of the claim and understand the risks involved with making a fraudulent claim. And the claim will also need to include details of the agent, which is something that as a firm we've always been happy to provide. Another big change as well to R&D is that there'll be a need to tell HMRC in advance that you intend to make an R&D claim. So at the moment, there's no requirement to do that. So we're told that there will be an online form to complete, and that will need to be done within 6 months of the end of the accounting period. So it's really important that that's done. If you miss that deadline, then you're potentially unable to make a claim. We've also been told that if you made a claim in any of the 3 previous years, then you shouldn't have to go through that process. You shouldn't have to tell HMRC in advance because you're already on their radar. But we're yet to see the full details of that. So I did read something yesterday that suggests that in certain circumstances you may still need to make that claim notification. So it's perhaps not as clear cut. Next slide, please, Rob. So if you are a theatre, an orchestra, a museum, or a gallery, then you've probably had a bit of a tough time of late, particularly with COVID. Obviously, we weren't going out to the theatre during the lockdown. So I think back during the pandemic, HMRC decided to increase the rates of tax relief available to theatres, orchestras, museums, and galleries. So that came in during the pandemic. That was due to expire this month. But we were told in the spring budget that relief will be extended for another 2 years. So this is really good news for theatres, orchestras, museums, and galleries. So these temporary rates of tax relief. So we're looking at the rates of 45% and 50% for theatres. Those high rates will continue for another 2 years. So it's important that you make those claims. And we've done a number of claims for theatres over these last few years. There's also some changes coming in to do with where you spend the money. So in the past, there's been a requirement to spend the money in the EU. Obviously, following Brexit, things have changed. So now there's going to be a requirement to spend a significant chunk of the money in the UK. So they want the money to be spent here rather than overseas. And we're told that the tax relief that's available for museums and galleries in the UK, that will be extended until 31st of March 26. So that's some more good news if you happen to be in that sector. Next slide, please, Rob. Just very briefly, because I suspect we won't have many people who are producing films, TV, and video games. But if you are producing film, TV, or video games, then you need to be aware that from next April, the method of tax relief is changing. So instead of claiming an additional deduction in your tax comp, you will claim an expenditure credit. So this will work in a similar way to the R&D RDEC scheme. So yeah, we've got credits instead of additional deductions. So that's coming in next year. So something to be aware of. Next slide, please, Rob. And just finally from me, that there's been a change to the seed enterprise investment scheme. So this came in April, this month indeed. So I guess it's good news if you're a company looking for SEIS investment, because the limit, the amount that can be invested in the company is increased by significant amount, by 2/3, up to 250,000. So good news if you're looking for investment through SEIS. And in addition, to enable more companies to use SEIS, what they've done is increase the gross asset limit to £350,000, and they've increased the age limit from 2 to 3 years. So more companies are potentially able to benefit from this. It continues to be extremely generous for investors, and the investor limit has now doubled from 100,000 to 200,000. So if it's maybe something you've been considering in the past, but it hasn't quite worked for you, perhaps it's time to revisit it, obviously in light of these new rules. And that's it from me in terms of business tax. So I'll now hand over to Stephen, who'll talk about national insurance. Thank you.
Thanks, Craig. It was great you put together all the slides for us. So yeah, we are grateful for Craig work on that, putting together the presentation. Yeah, national insurance. So national insurance is normally quite a sort of boring sort of tax. Nothing, well, not technically a tax, but a contribution. But yeah, generally not much changes. But last year was a bit of an exception. So the rates were increased by 1.25% across the board. And they also increased the tax on dividends by the same amount. But then, of course, in the statement in last autumn, they did reverse those changes. And so we're now back to the same rates as we had in 21-22 tax year. So the contributions are set out there for you. We do have a slightly enhanced threshold for employees. That's the primary threshold. So employees don't start paying national insurance now until they're earning £12,500. But the employer's threshold has stayed the same. Well, not the same, but it's still quite a lot lower. So employers basically pay 13.8%, whereas employees pay 12%, but then that is capped, and then above sort of around 50,000, they just pay 2%. Next slide, please. So a similar position for self-employed, class 4, which is the national insurance that self-employed people pay on profits. That is only now applying at sort of £12,500, and then it's at 9%, and then drops to 2%. It is just worth mentioning that you still get a national insurance record if you are earning around sort of £6,500. So even if you're not paying any national insurance, you can still get a national insurance record, which is important for state pension purposes. Unfortunately, they didn't reverse the increase in the dividend tax rate. So although they reversed the national insurance increase, they didn't do the same for dividends. So the dividends are paying more tax than they used to. Next slide, please. So electric cars, obviously seeing a lot more electric cars on the roads. They're still very, very efficient for tax purposes, almost unbelievably so, really. So at the moment, that's just a 2% benefit in kind charge on an electric car provided to an employee. So say it's a £40,000 car, the benefit in kind would only be £800 for the year. So if you're a 40% taxpayer, that's only £320 a year of tax. So, you know, really very generous. Although those rates are going to go up, that's a very gradual increase. So next year, 24-25, it'll still be at 2%, and then it's only in April 2025 that will start creeping up, so 3% and 4% and 5%. Obviously, change in government could change those, but that's where they're set at the moment. In addition, the company gets capital allowances on the cost of the car, which Craig's referred to, so 100% tax relief in the year of purchase. There is a balancing charge on the company when the car is sold, based on sale proceeds. But then if that's replaced by another car, you probably won't be particularly adversely affected by that. It's important to note that electricity is not considered a fuel for these purposes. So even though an employee might be charging up their electric car in the workplace through charging points, that doesn't mean they have a fuel benefit in kind. If they're paying for their own fuel, if they're charging it up themselves on their own electricity and stuff, then they can reclaim from the company a mileage, 9 pence a mile for business miles. And if it's their own car, so not a company provided car, then they can claim the full 45p per mile. So for other cars, we're seeing a 1% benefit in kind rise. But that, again, that's not coming until 25-26. And if the car's under 75 grams of CO2 emissions, then there are predicted additional 1% rises in the following years as well. But again, that is all subject to government changes, etc. Private fuel benefits. So if the company provides diesel or petrol for an employee for a company car, then that is a very expensive benefit in kind. So it's 27,800 times the benefit in kind for the car, opposite your marginal tax rate. So that we do see very few people receiving that benefit now, because it just doesn't make sense really for most people. Next slide, please. Just a little bit on company vans. So the benefit for having a company van is slightly increased to 3,960. But if it's electric van, we're seeing more of those on the roads, aren't we? Then there's no benefit in kind at all. Now, for a van, it is acceptable for the employee to use that for commuting purposes. So if they keep it at home, then that doesn't necessarily mean that that's liable for the benefit in kind charge. So it's a little bit more generous around the rules around for vans as opposed to cars. Still got the hangover from the Coca-Cola case. So just to remind you, that was a case where the Coca-Cola employees had vehicles which had sort of goods area at the back, but did have a second row of seats. I think generally was a removable seats behind the driver's seats. But the court decided that was actually a van. Sorry, that was a car rather than a van, because it was designed partly for moving people as opposed to just goods. So that has caused a bit of a stir. So if you do have vehicles which are a bit of a hybrid between a car and a van, that's certainly something which needs considering. Next slide, please. So on the EMI, this is a share option scheme, a government approved share option scheme, which is very attractive to small and medium-sized companies. Most popular scheme, share option scheme that we deal with, really. There's just been a few administrative changes just to make things a little bit easier. So you no longer have to detail all the restrictions over the shares in the option agreement. So if there's restrictions in the articles, then you don't need to repeat all those in the option agreement itself. And there's no longer a requirement for the employee to sign a declaration that they're working more than 25 hours a week for the company. They still do need to commit to that, but they don't need to sign a specific declaration. I think most importantly, there's adjustment to the notification procedure. This only comes in from April next year, but up to now, companies had to report to HMRC through the online portal within 92 days of new options being granted. And that has caused problems in the past, because if that's not done, then the options don't qualify for the tax reliefs. So sometimes we've seen people miss that deadline and then have to re-grant the options, which is a lot of hassle. So now it's being extended. You just need to notify it after the end of the relevant tax year. So that's a very positive change, I think. EMI, basically, you can have options up to £250,000 per person. Thanks, Rob. Next slide. So company share options scheme plan is a sort of a bit of a competitor to the EMI. We've not seen many people use it, basically because it's been a little bit more restrictive. You could only have 30,000 of option value, but that has now been enhanced to 60,000, and some of the restrictions have been relaxed. So again, a positive change, but I guess most people will stick to EMI if they can, and CSOP is just a sort of alternative if you can't meet the conditions for EMI. Thanks, Rob. So just a few things on childcare. That's been made more generous. Obviously, a lot of noise was made about that at the budget. So it's going to be 30 hours of free childcare per week. And at the moment, it's only for children 3 to 4, and that's going to be extended downwards to those from 9 months onwards. It's coming in some stages. So April next year, 2-year-olds can have 15 hours. Then September 2024, it's from 9 months, can have 15 hours. And the plan is September 2025. All children over 9 months will have the full 30 hours. So it's being staggered, I presume, partly to allow the capacity to be created within the childcare system, really, as well as saving some funds for the government. And there's also some changes for the universal credit childcare. Thanks, Rob. Continuing a trend, we've seen some substantial increases in national minimum wage. So that's now over £10 for those 21, 22-year-olds. To give you an idea, for someone working 35 hours a week, that's an annual salary of around £19,000. Obviously, that may impact, will impact businesses with those on national minimum wage salaries, but also obviously there's a ripple effect through the business as the employees who are slightly more senior expect pay rises too. So yeah, quite a big impact on businesses, I imagine. Thanks, Rob. So just a few things on VAT. Again, continuing a trend, the registration threshold of 85,000 has been frozen, continues to be frozen. It's been there for a long time. I mean, it is quite a high threshold, I think, internationally. And the government's obviously felt that it's maybe not too high, but yeah, certainly as high as they wanted to go. So it's stayed at 85,000. All VAT registered businesses now within Making Tax Digital have to keep digital records and use that process for filing their returns. Quite a major change we've had is a new penalty regime. This is generally thought, I think, to be a very positive change. At the moment, we've had a sort of default system, so that if you default over a period of time, penalties increase as a percentage of the VAT for that return. And we have seen there have been reports of very large penalties being assessed on people who have just been a day or two late because of the way the system worked, which seemed quite unfair. So I think this new system is much more equitable. Basically, it's a point system for late filing returns. Once you get to 4 penalty points, you'll get a penalty, and that'll be sort of £200 for a late return. And the points then should drop off after sort of 2 years. There's also a separate system for late payment of VAT. Again, this is, I think, a reasonable system. So if the payment is within 15 days of the due date, then there's no penalty at all, which I think is quite generous. If it's within 16 to 30 days, the penalty is 2% of the outstanding balance. And if you go over 30 days, then you do have a 2%, an additional 2% penalty of what's still outstanding. And then also a 4% sort of interest charge as well. So I think that very reasonable changes, sensible changes on the penalty front, which hopefully people aren't incurring VAT penalties, but if they do by mistake or unfortunate series of events, then hopefully that won't be partially treated under this new system. So thanks, Rob. I think Aaron's going to take over for personal tax now. Thank you.
Good morning, everyone. The income tax personal allowance had already been fixed at 12,570 until April 2026. It's now going to be maintained at this level for an additional 2 years until April 2028. It's also worth noting that there's still going to be a reduction in the personal allowance for those with income over £100,000, and the reduction is £1 for every £2 income goes above £100,000. So there's no personal allowance where adjusted net income exceeds 125,140. And you should note that the effective tax rate on income between 100,000 and 125,000 is up to 60%. However, for people that have total income between within that band, there is the potential for them to mitigate the effect of the 60% tax rate by looking at making personal pension contributions. The higher rate tax threshold and national insurance upper earnings limit have been frozen at 50,270 until April 2028. And I think we could say that the freezing of allowances and rate bands is what can be described as stealth taxation or fiscal drag, in that wages are increasing due to inflation, but the allowances and rate bands aren't. And that means more people are being dragged into higher rates of tax. There is one threshold that's been moved, and that is the additional rate threshold. Unfortunately, it's been moved downwards from 150,000 to 125,140, and that's going to drag more people into that 45% tax rate. Again, people may be able to look at making personal pension contributions, which could mitigate the effect of that, since those personal contributions extend the rate bands by the gross amount of the contribution. Next slide, please, Rob. Dividend tax rates. So in 22-23, the dividend tax rates were increased by 1.25% across all bands, to result in a dividend tax rate of 8.75% for dividends in the basic rate band, 33.75% for dividends in the higher rate band, and 39.35% for dividends in the additional rate band. Now, the rates are set to stay at these amounts. However, for 23-24, the dividend allowance, which is the amount of dividends you can receive tax-free, is being reduced from 2,000 to 1,000, and there's going to be a further reduction down to £500 for the 24-25 tax year. Now, the additional tax burden of this change for 23-24 is going to be up to £87.50 for a basic rate taxpayer, about £337.50 for a higher rate taxpayer, and £390.35 for an additional rate taxpayer. That's going to have a bit of an effect on people with reasonable amounts of investment income. Next slide, please. So, making tax digital for income tax. So, just to give you a bit of background, if you don't know much about making tax digital, MTD is going to require certain individuals to keep accounting records in a digital format and submit tax returns to HMRC on a quarterly basis using MTD compliant software. It was originally due to be implemented from April 2024 for self-employed individuals and landlords with turnover in excess of £10,000. The good news is that it's now been delayed and a phased approach is now going to be applied. So self-employed businesses and landlords with annual business or property turnover above 50,000 will need to go into MTD from April 2026. And self-employed businesses and landlords with turnover of over £30,000 will need to go into MTD from 6th of April 2027. And the government's going to review the needs of smaller businesses, particularly those with turnovers under £30,000, before announcing any further requirements for them. And the rules and commencement dates for partnerships and companies are yet to be confirmed. So watch this space on that. Next slide, please. As Stephen's already talked about the penalty regime for VAT, and basically what we've been told is that the late payment penalty regime and late filing penalty regime for income tax is going to be updated so it mirrors that VAT regime. And that's going to be from April 2026 for those who join Making Tax Digital in April 2026, and it will apply from a later date for all other taxpayers. So as Stephen's already alluded to, if you've got a late payment of tax, you can have tax geared penalties based on how late the tax is. And in terms of late returns, it's going to be a points-based system. Next slide, please, Rob. So accounting periods that are not aligned with tax years. Historically, self-employed individuals and partners have been taxed on the profits arising in the accounting period that ends in the tax year in question. However, from 6th of April 2024, everyone's going to be required to be taxed on a fiscal year basis. So that'll be the profits for the year to 31st of March or 5th of April. And this means that businesses that don't have a 31st of March or 5th of April year end will either need to change their accounting periods to align with the tax year or carry out apportionments each year of the accounting periods that straddle the tax year in question. 2023-24 is going to be a transitional year, and that's going to result in an acceleration of the point at which business profits are taxed for some people. So, for example, for 23-24, the business that's got a 31st of December year end is going to be required to bring in the profits for the year ended 31st of December 2023. Plus, they're also going to have to bring in an additional 3 months of profits up to 31st of March or 5th of April. So they're going to be bringing in 15 months of profit into that tax year rather than 12. Some people may get a deduction for overlap relief. Now, overlap relief is a portion of profits that's taxed twice under the old opening year rules. However, that may well not be enough to cover the additional profits. And that could leave some additional profits subject to tax. But the government have introduced some transitional rules here. So those additional profits that are brought in can actually be spread over 5 years. So that's quite welcome. But I think the main point is to look at your accounting period and look at whether you need to align that with the tax year. Next slide, please. No major changes to rates or reliefs on the CGT front, but there is a continuing theme of allowances reducing, with the CGT annual exemption going down from 12,300 to 6,000 from 6th of April 23, and then it'll be further reduced down to just £3,000 from the 6th of April 24. Just a reminder about capital gains tax on the disposal of dwellings. If you dispose of a dwelling that's not been your main residence throughout your period of ownership, you may have a capital gains tax liability on it, and you have to report and pay the capital gains tax on that within 60 days. And to do that, generally you have to set up an online account and submit an online return and then make the payment. In certain situations, you may be able to do a paper return. So if you are looking at disposing of a property going forwards, then that's something you have to bear in mind. It's also something we can help you with as well. Next slide, please. So capital gains tax and divorce. So transfers between spouses are generally done on a nil gain, nil loss basis for capital gains tax, which means assets can be transferred between spouses CGT free. Historically, in a divorce situation, this nil gain, nil loss treatment is only applied in the year of separation and not in any subsequent tax years, and that can create capital gains tax issues. So, for example, if you've got a transfer of an asset after the year of separation, it's deemed to take place at market value, and a capital gain can arise based on the market value less cost, and that can be subject to capital gains tax. However, the government have now announced a welcome change to the rules so that separating spouses and civil partners will be given up to 3 years after the year they cease to live together in which to make nil gain, nil loss transfers. And also, nil gain, nil loss treatment will also apply to assets that are transferred under a formal divorce agreement. And our understanding is that will apply even if the formal divorce agreement takes place after that three-year window. So definitely a welcome change there for divorce situations. Slide, please. On the inheritance tax front, no major changes announced. Again, continuing with the theme of stealth taxation and fiscal drag, in that the IHT nil rate bans have been frozen until April 2028. You can see, in fact, that the IHT nil rate ban has been frozen at 325 since April 2009. We're dragging more people into the inheritance tax net. Next slide, please. So we've also been told about some changes to estates in administration and trusts, which are not going to come in until April 2024. When we talk of estates in administration, that's the estates of deceased persons and the settling of income tax and capital gains tax on income arising in that period post death, but before the estate is finalised. It's been a bit of a welcome change in that the trust and estates with income up to £500 will not pay tax on that income, and that's good news, particularly for estates, because historically estates have to pay income tax on any income arising, which has created a bit of a compliance burden for even low value estates in having to settle that tax with HMRC via an informal or formal route. Been a change. There's going to be a change to the taxation for trusts in the trust standard rate band, which applies basic rates and ordinary dividend rates to the first £1,000 of income. So that's going to be abolished. The beneficiaries of UK estates are not going to pay tax on income distributed to them that was within that £500 limit for personal representative. So again, that's another welcome change in relation to estates and the beneficiaries of estates going forward. Next slide, please. Now, moving on to pensions, I think this was an area that grabbed most of the headlines in the recent budget, particularly in relation to the lifetime allowance. The lifetime allowance is a cap on pension savings of slightly over £1 million, which, if exceeded, leads to 55% tax charges. Now, this charge created considerable opposition from certain highly paid professionals, particularly senior doctors in the NHS. And the government associated this with a reduction in activity from those affected professionals. And they've thus moved to abolish the lifetime allowance charge in order to incentivise those individuals to go back to work, basically. So, however, the sting in the tail is that the maximum pensions tax-free lump sum is now being frozen at 25% of the current lifetime allowance limit. So that's going to be £268,275 is a maximum tax-free lump sum that anyone can take. So the effect of these changes broadly is that from April 2023, pension drawings in excess of the tax-free lump sum are going to be taxed at the individual's marginal tax rate. 55% tax charge won't arise. In addition, the government have announced that a 55% charge will not arise on certain lump sum payments, to include the serious health lump sum and death benefit lump sums, so they'll be taxed at an individual's marginal tax rate instead. In further good news, the annual pension contribution allowance is going to be raised from 40,000 to 60,000 from 6th of April this year, and individuals will still be able to carry forward unused annual allowances from the previous 3 tax years. At the same time, the money purchase annual allowance is going to rise from 4,000 to 10,000, and the minimum tapered allowance from 4,000 to 10,000. And to go along with that, the adjusted income threshold for the purposes of tapering the annual allowance will rise from 240,000 to 260,000. So that's where, if your income exceeds that threshold, your annual allowance is broadly reduced by £1 for every £2 that you go over. That's now going to be subject to a minimum floor of 10,000 rather than 4,000. If the contributions you make exceed that tapered annual allowance, then you may face an annual allowance tax charge, or you will face an annual allowance tax charge, unless you've got enough brought forward annual allowances. So it's a welcome change that threshold has increased, so less people will get caught by the annual allowance charge. But nevertheless, you still need to monitor whether you're going to be caught by that, particularly if you're self-employed and your profits fluctuate from year to year. You do have to be really careful with pension planning on that front. That's something that Hawsons Wealth Management can help you with in conjunction with us in the tax department. So they're all in all some positive changes on the pension front. But obviously, there's also a lot of speculation as to whether, if the Labour government get in, that they'll reverse those changes. I think that wraps it up from my angle. I think we did have some questions submitted to us, which coincidentally is mainly on the pension front. Just have a look at those. So I had a number of people asking whether the latest pension changes are going to be reversed by the next Labour government, and I think basically, yeah, the Labour the Labour Party have come out and said that they would look at abolishing the changes, and they would look at bringing back the lifetime allowance and lifetime allowance charges. So at this stage, all we can say is, yeah, that's what they've said in the press. So we'd have to assume that they would look at reversing those changes, but who knows? Things can change very quickly. So another question related to that from Graham is that would the next Labour Chancellor look to enact legislation based on recommendations by the IFS to abolish the 25% tax-free lump sum and also include residual pension funds within the estate of a deceased person, rather than those funds being outside of the estate and therefore exempt from IHT as they are now? Obviously, it's sort of difficult to really comment on that, to be honest. I mean, I would see such changes as acting as a disincentive for people to save into their pension. And therefore, maybe that, from a political point of view, wouldn't be a good move. But again, you know, who knows what we'll do, what they'll do going forwards on that. So just watch this space.
Yeah.
Have you had any other questions submitted? You guys, Craig, Stephen, got any other comments on those pension queries in terms of what might happen in the future?
Yeah, I mean, all we can say is, you know, what the Labour Party have said, that they'll reverse the abolition of the lifetime allowance, so effectively bring it back in. They'll also have to do something about doctors, because that was one of the whole reasons for abolishing it, is because the consultants retiring early to try and avoid that charge. But yeah, very much up in the air. It's just really speculation, really. I think we've dealt with the two questions which came in on the questions and answers as well. So there's one question here. Do the panel see any options now for lower corporation tax levels in the future? I mean, I think with the full expensing of capital expenditure, the Chancellor has kind of taken some of the sting out of the increase in corporation tax rates. So I suspect we have to accept that 25% CT rate will apply for at least some time now. So yeah, obviously, you know, the government's got to be competitive with other countries, so we'll be swayed by what other countries are doing, I think. But yeah, they do seem quite committed to this 25% rate, unfortunately, for the time being. So I'm not aware of any particular announcements or anything which suggest they might reduce that again. But I think what we can say is, you know, thanks everyone for attending. We will be sending out the slides after the session. So if you do have any questions you want to raise, then, you know, by all means get in contact with one of us by email or phone. Happy to chat through any issues you've got. But yeah, thank you very much, and hope you have a good day. Thank you.
Everyone.
Thank you.